You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank global banking and markets leaders designed to provide you with timely insights and analysis. 2020 was the most surreal year many of us have ever experienced. Meanwhile, the Canadian dollar seemed to behave normally, which is, of course, an extremely Canadian thing to do. Here in 2021, global economies have some heavy lifting ahead. But what should we expect from currencies? For our first episode of 2021, we welcome back Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank, to find out what may be in store for the US and Canadian dollars. Shaun, Happy New Year and welcome back to the podcast, first guest of the year.
Thank you, Greg. Happy New Year to you.
None of us really expected 2020 to go the way it did, certainly at the beginning of last year. What about, your area of expertise, of course, is currencies. What about the Canadian dollar? What was its behavior through this strange year?
Well, in some ways, 2020 was an unremarkable year for the Canadian dollar. And I know that sounds a little odd in the context of the volatility that we saw in March when the US dollar appreciated rapidly to the 146 area and then unwound very quickly a lot of those gains. But just hear me out here. I say unremarkable for a couple of reasons. Firstly, because the pattern of trade overall for the Canadian dollar, that's to say the US strength that we saw in the early part of the year, followed by the CAD strong recovery through the middle of the year and into Q3 especially, was very much in keeping with the kind of seasonal pattern of trade that we see in the Canadian dollar. When we look at the average performance of the currency on an annual basis over the past 30 years, it was very much almost point for point in keeping with that profile. And unremarkable perhaps for a second consideration, because when we look at the year overall, measuring from the start of January to the end of December, the CAD was actually very little changed against a generally weak US dollar, despite ranging between 146, that high point, and 126, the low of the year. Well, that's between 68 cents and 78 cents US roughly. So last year overall, the CAD rose just a little more than 1.5% against the US dollar, which was actually the worst performing G10 currency against a very weak looking US dollar for 2020 overall. It lagged its commodity peers, the Australian dollar, which rose nearly 10% against the US dollar, and the New Zealand dollar, which rose around 7%, as well as the euro, which gained around 10% itself over the course of the year. So the CAD even underperformed the pound sterling, which for much of the year was trading under the cloud of Brexit pessimism. So it was really an odd year, despite an odd, unremarkable year for the Canadian dollar, despite all the volatility that we saw in markets around FX.
So what was really behind that lag in the Canadian dollar then? Why wasn't it performing alongside that other basket against the dollar?
I think the CAD had a hard time sort of detaching itself from the North American narrative, and by that I mean the US dollar. In a way, it got lumped in with the broader market bearishness that dragged the dollar down, mainly because I think there was nothing too remarkable going on here domestically to make the Canadian dollar stand out. The Australian dollar and New Zealand dollars, by contrast, benefited from the rebound that we saw in the Asian economies pretty quickly after the COVID situation settled down there. China recovered very strongly from March, April onwards from its COVID-19 experience, and strong gains in industrial and precious metals prices especially were supportive for the Australian dollar as well. For example, the euro, meanwhile, was boosted by clear signs that investors were moving away from the US dollar denominated assets and into arguably perhaps under-owned and better value European equity markets. And that's a trend that appears to be continuing as we speak and move into the new year. And meanwhile, there were some distinct headwinds for the CAD, I'd say, early on last year. For example, the low and even very briefly negative oil prices certainly had an impact on perhaps the perception of the Canadian dollar for investors in the early part of this year. And also the market volatility around the COVID-19 situation weighed on risk sentiment and helped lift the US dollar generally in the early part of the year. The reality is, though, that the CAD spent most of the year trading at a quite significant discount to our estimate of fair value. It maintained about a one standard deviation below fair value for close to 3/4 of the year, according to our modeling. that undervaluation has corrected. We see the CAD gains more recently, bringing it more in line to fundamental fair value, but it's taken a bit of time to catch up with that, I'd say.
Going back for a moment, just to the comment about sort of the Canadian dollar behaving along seasonal trends, what forces in a year of such uncertainty, what forces were at play that allowed it to still behave in an expected way?
It, I'd say it was unexpectedly expected. I think given the volatility that we saw, it was quite surprising to see that pattern play out. It's been very consistent over the last 25 to 30 years, where we see usually the US dollar strengthen in the first quarter. The best period of the year for the Canadian dollar tends to be the middle of the year, the second and third quarters especially, and then we tend to see the US dollar correct a little bit into the tail end of the year. That middle of the year period, which is typically the best period of the year for the Canadian dollar performance-wise, generally reflects a rebound in energy prices. Energy prices tend to strengthen seasonally as well. As we move into the middle of the year, that reflects increased demand for refined product as the US driving season typically gets underway. Less so perhaps this year, but we did see a rebound in energy prices from those very low and even negative, very briefly negative rates that we saw for front month futures in crude oil around March. So the seasonality in both commodity markets and how that translates into the sort of seasonal effect to some extent on currencies did persist this year, despite the broader market volatility that we saw and the uncertainty that created in other markets.
Okay, well, let's leave 2020 behind, as I'm sure many of us want to do, and look forward to this year. How do you expect the various global economic recoveries will play out in the currency markets?
We've had a pretty big move in FX markets in the past few weeks, in the past few months. But we tend to look at these things in terms of sort of calendar years, and we generally expect 2021 to see the US dollar remain relatively soft. The sell-off in the dollar did accelerate quite sharply in the latter part of last year, and it has left the dollar in fact, trading close to where we thought we would be at the end of 2021. So we do have to go back and take a look at our forecasts to reflect that rather rapid sell-off, quicker sell-off than we had expected. Even so, I don't expect the trend to change really for the dollar, because the broader fundamental outlook that we base that view on, that dollar bearish view on, is unlikely to change in any significant way. The dollar will remain soft because we think growth and interest rate differentials between the US and other large industrialized economies are narrowing and will likely remain relatively narrow. Historically, and we've talked about this previously in podcasts, historically, when we've seen these sorts of situations in the past, investors tend to look beyond the US dollar and US financial markets for better investment returns and opportunities. And we're seeing that already. As I mentioned a moment ago, with investors in the US moving more assets into European equities, and that's driven the euro, or helped drive the euro higher over the past few months. I think the US dollar could benefit from an increase in market uncertainty. If we were to see that, it will retain that safe haven or liquidity haven characteristic that we saw emerge prominently, mostly in March. But we generally expect the broader investment environment to remain relatively calm and quite benign, because global monetary policy and fiscal policy settings are poised to remain extremely relaxed through the coming year at least. We have heard some grumbling about the weak dollar and the risk that the strong Canadian dollar could undermine our exporter base here in Canada, but I think those concerns are probably somewhat overstated at the moment. As I mentioned earlier, the CAD strength that we have seen overall was really quite limited despite the volatility. And perhaps more importantly, I think it's notable that the last two recoveries from recession that we've seen in the US have been accompanied by a weaker US dollar. If a weaker US dollar facilitates a US economic recovery, I think that's a price that other large economies might be willing to pay. I think problems generally arise with exchange rates when currency trends become extremely disorderly and volatile. And that's not the case, at least with the dollar decline at this point. And we expect it to remain a relatively slow burn affair, a fairly gentle decline over the course of the coming 12 months.
Do you think there's a long-term trend at play with respect to what's been happening to the dollar through our various recessions and recoveries over the past few years, and then thinking about how this may continue into the future as the economy ebbs and flows?
I certainly think there is a longer term kind of secular trend in the dollar that's been pretty persistent over the last 30 or 40 years, essentially since the end of Bretton Woods in the 1970s. We can look back at the history of the dollar, and we can see these alternating waves of relative weakness and strength that persist for quite sustained periods of time, but average out fairly clearly, fairly consistently to around about 8 years in terms of the length of those cycles. And that's been one of the reasons why, over the last few years at least, our underlying bias towards the dollar has been to expect the dollar to soften, because in 2016, 2017, we saw the peak of the last dollar bullish cycle turn and reverse. And we did expect the next few years to be essentially shaded by a tendency towards dollar weakness. And that appears to be what is playing out here, this longer term secular trend towards not necessarily a significant weakening in the dollar, but certainly a softer profile against its major currency peers.
And what about the new U.S. administration? Of course, in spite of the very unfortunate events at the U.S. Capitol, Joseph Biden will be the next president of the United States, and he will be bringing along with him a brand new administration. So what will you be watching for from the currency perspective?
That's going to be an interesting issue, I think, over the next few weeks. As I say, I think we generally expect the dollar to continue to weaken in the coming year. I think expectations have adjusted to some extent. Investors are underweight the dollar now. They have the short dollar position on to some extent, and the bad news for the US dollar, I think, is largely priced in. The story of low rates and sluggish growth, I think, is well discounted into the dollar at this point. Downside risks for the dollar, I think, do revolve around the economic outlook and policy framework, and that's going to be important, I think, for markets to judge and assess over the next few weeks as the new administration comes in. If growth in the US were to disappoint more and the new administration adopts a more aggressive fiscal policy, or the Fed moves to ease policy again, the dollar may well weaken. I think there will be some focus on the new Treasury Secretary. We assume that will be President-elect Biden's pick, Janet Yellen, the former head of the Federal Reserve. I think given the soft dollar tone that we've seen emerge in the past few months, markets are going to be particularly keen to see if Yellen chooses to dust off the strong dollar, in air quotes, mantra that has been a part of the Treasury Secretary's toolkit essentially since the mid-1990s. This turn of phrase has been employed with varying degrees of enthusiasm by various Treasury Secretaries since the Clinton era. And it is more than just a token comment. It doesn't necessarily prevent the US dollar from weakening, but it does help reassure foreign investors that US dollar weakness will not turn into a rout, which could undermine the broader stability of the Treasury market. And that's going to be a key consideration for this new administration, given the level of fiscal balances that the US is running at the moment.
That was Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. You can now find Scotiabank's Market Points on Apple Podcasts, Google Podcasts, and Spotify. Don't miss an episode. Subscribe on your favorite podcast platform. And we want to hear from you. Please rate and review the show. Your feedback helps us improve the content we create for you. You'll find more thought-leading content on our website, gbm.scotiabank.com. And you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. I'm Greg White. Thanks for listening.